Good morning, everyone. My name is Shiraz Khan. I'm the head of the tax practice at Al Tamimi and Company across the Middle East and North Africa. If you could move on to the next few slides, please. So the purpose of today's presentation was to talk about transfer pricing and just give you an update in terms of what's happened since the introduction of corporate tax in the UAE and give you an exposure, an overview of the UAE transfer pricing regime. But I think before I go into the contents, I wanted to really talk about. I think first of all I should introduce my colleagues, Yanis Nanos, who's a transfer pricing lead, and also Saif Al Abdullah, who's an associate in the team. So yeah, going back to transfer pricing, I wanted to give you a brief introduction about what transfer pricing is and why it's important. So transfer pricing deals with the pricing of transactions between related parties. Why is it important from a tax perspective? So essentially, transfer pricing rules are anti-avoidance rules used in related party transactions. So in a typical situation where you have someone who's selling something, goods or services, they'll of course want the maximum possible price. But on the other hand, you have a buyer, and the buyer is not going to pay whatever price the seller wants. They'll only pay the price which other people will pay. In other words, the market price. So there is a check and balance when it comes to non-related party transactions. The seller could only charge so much because the buyer will only pay so much. So this is in a free market situation. On the other hand, if you have a related party situation where you have a parent company and you have a group of companies and a number of subsidiaries underneath that company, they have a common shareholder. The shareholder doesn't care about what profits are paid at individual level, provided that from a group perspective, the taxes paid is efficient and is low. And if you can manipulate the price in related party transactions, then you can actually reduce your tax liability. So you could reduce your sales value, you could inflate your expenses, and that would allow you to reduce your profit and thereby reduce the tax. And you can manipulate the price in related party transactions for this reason, because you're related parties. So this is why transfer pricing is important. It's essentially in each tax law, there are rules called transfer pricing rules, which are essentially anti-avoidance rules, preventing you from manipulating the price. And you have to document, you have to essentially ensure that the price which you've agreed on is the arm's length price, which is a price that would be agreed on between two parties had they not been related. And in addition to that, there are also requirements to maintain documentation to support the fact that you've entered into a transaction which is being conducted on arm's length terms. So just going back to the previous slide, sorry, I just wanted to quickly touch on the agenda again. And so we're going to give you an overview of the transfer pricing regime in the UAE. We're going to then talk about the applicability to entities in the free zones. Before we look at some special transactions, intra-group transactions, some transactions when it comes to financial services, intangibles, and also, the application of transfer pricing when it comes to permanent establishments. Before we look at the impact of transfer pricing on taxable income and how the adjustments will impact the taxable income. And then finally, we'll conclude the presentation, advising you on recommending you what to do in order to prepare. Of course, transfer pricing is very, very new in the region, and there's been a lot of historical practices which companies are engaged in, which will no longer be acceptable. So for example, there's many entities set up in groups and there's transactions they're doing between each other. And for legal purposes, each entity is a separate legal entity and there should be a charge, there's some kind of consideration charge for goods or services which are being supplied, but this is not happening. In addition to that, there's no contracts between the entities. In some cases, there's no invoicing either. So these historical practices will have a big impact, in terms of going forward. If we move on to the next slide, please. So just before we go into the main presentation, some housekeeping points. The session is being recorded. We will share this a recording of the session after the session. The audience is muted, so please do submit any questions that you may have through the Q&A function. And of course, at the end of the presentation, we'll do our best to address these questions. There are some poll questions, so be ready to answer these questions, and it'll be good to have your participation. And finally, if you can't hear us, please make sure you're connected your audio by choosing either connect through your computer, audio, or phone. So in terms of the timeline, and we've seen a number of developments happen, how the UAE has aligned with international developments, and how it's committed to comply with another number of international commitments, and how generally it's aligned itself with best practices which are happening in other countries. I think the starting point of this pretty much was in May 2018, where UAE joined the BEPS Inclusive Framework. This involves currently 140 members who've committed to apply or incorporate four minimum standards in their domestic law. Then in April 2019, the UAE introduced country by country reporting requirements and economic substance regulations. Of course, the country by country reporting requirements require you to report certain data in relation to the group and its operations in all the jurisdictions which you operate. And also the economic substance regulations, which were in response to UAE's blacklisting by the EU. And essentially, the economic substance regulations require you to comply with certain economic substance requirements if you undertake certain relevant activities. Then in December 2022, the corporate tax law was issued, and embedded inside the corporate tax law is transfer pricing rules. So the corporate tax law does set out the arm's length principle. It also sets out 5 methods which should be applied to determine arm's length price. And in addition to that, it sets out requirements for documentation and definition of related party and control. So these are important and they should be taken into account. And broadly, the UAE transfer pricing rules are aligned with OECD. So you can still continue to rely on OECD guidance. Then in April 2023, we had a ministerial decision which set out requirements for maintaining transfer pricing documentation, and in terms of thresholds which are required to be met in order for you to comply with transfer pricing requirements. Then in October 2023, the FDA published a transfer pricing guide, and this is a very detailed guide. It's around 140 pages. It has a lot of detail, and this would be, after the law, the primary reference point in terms of the FDA's approach in dealing with transfer pricing. Of course, a lot of the things in the transfer pricing guide have been incorporated from OECD guidance. So you could still rely on OECD guidance to the extent that things are not covered in the FDA guide. And then finally, in November 2023, we had a decree law which is published on the global minimum tax of 15%. Of course, we have 2 tax rates under the law: a 0% law, 0% tax rate for income below a certain threshold of $100,000 roughly, and above that is 9%. But for those entities which fall under the BEPS Pillar 2 scope, for example, entities which have global consolidated revenue of around more than 750 million euros and operate in 2 or more jurisdictions, then a higher rate will be applicable.
So now we can basically start with our poll question. The question is today: how prepared are you in relation to your transfer pricing in the UAE? Well prepared, somehow prepared, or not prepared? We give you a few minutes, guys, to respond. Okay, yeah, it's quite interesting. We see that most of you, more more than 55% is somehow prepared. And yeah, it's quite interesting results. Yeah, it will be interesting to see what that actually means. So next slide, please. So in this slide, we're going to cover the main concepts around transfer pricing in the UAE. So as Siras mentioned previously, transfer pricing deals with transactions between related parties, and transfer pricing legislation aims to secure the taxable basis for tax authorities from the contact between related parties. So in order to reduce any tax leakage from related party transactions, that's why transfer pricing rules exist. From a design perspective, each transfer pricing regime system needs to have a few definitions. The first definition is around the definition of association or definition of related parties. So basically, which parties are considered related for transfer pricing purposes. We're going to see that in the later slides. The other concept that is quite critical is around the principle of the arm's length principle, basically meaning that all transactions between related parties should be conducted as they were independent. So that basically means that the price should be on a market rate. This is a commonly standard practice that is used. The arm's length principle is also initiated by the OECD, and many jurisdictions, many countries across the world, they are using that as the main principle. And the last part is around the transfer pricing regulation. As Siras mentioned previously, transfer pricing regulation in the UAE largely follows the OECD guidance. This is very welcoming news for the taxpayers because we have seen the application of transfer pricing rules based on OECD in other jurisdictions. So we already know to a large extent what will be expected as well from taxpayers in the UAE. And it's quite important as well that the FTA issued a very large guide with almost 140 pages explaining the application of transfer pricing and the treatment of related party transactions. So that shows a few things. Firstly, the importance that the tax authorities are showing on transfer pricing matters. And also, on the other hand, it shows as well how complex can be transfer pricing matters, and that is they require basically to be, checked and investigated quite deeply. And also, it's not transfer pricing. We are always saying it's not an exact science. It's not a black and white. So it always has some subjective nature. So this guide is very welcoming. It's very welcoming for the taxpayers. Next slide, please. So firstly, to start with definition of related parties and connected persons. So with regards to related parties, we don't see any deviation from what we have seen in other jurisdictions. Parties that, let's say, one entity owns more than 50% of another entity, these are two entities are considered related, or if there is any relationship through like kinship or through like a branch to a head office, branch with a head office, these are also considered as related parties. That's one pillar, is basically the relationship through ownership. That's the first aspect. The other aspect is a relationship through control. Control has, as you can imagine, it has also not that direct implications as the ownership is more, can have a bit more subjective nature. You should be checking the relationship via control through case by case. So it's not that direct as it is in the case of relationship through ownership. Apart from the related parties definition, what is interesting is the definition on connected persons. So connected persons is something unique and specific to the UAE, and this has resulted through the lack of personal income tax. Basically, if someone owns a company or is a director of a company, there is an incentive to pay a quite high salary to that person, so to reduce the taxable income of the company. That's why tax authorities in the UAE, they have introduced the concept of connected person, so an owner to the business or a director or any related party to these persons. Transactions between the taxable person and this person will be considered controlled, and they should adhere with the arm's length principle. Next slide, please. Now, in terms of types of transactions, as you can imagine, all types of transactions fall within the scope of transfer pricing. So you can have distribution of goods, purchase of assets, a sale of assets, tangible goods are included. Services, management services, head office services, legal services, any type of services are also included. Financial transactions like intra-group loans, guarantees, treasury function, cash pooling are typical financial transactions that are also falling within the scope of transfer pricing. Intangible properties, again, sale of patents, use of know-how or use of IP is also considered between related parties. It is a transaction that falls within the scope of TP. We should also mention that it's quite critical that not only cross-border transactions between related parties fall within the scope of transfer pricing in the UAE, but also domestic transactions, transactions between mainland to mainland companies, but also transactions between free zone companies and mainland companies. So all types of transactions and with cross-border or domestic as well, they should be included as part of this analysis. So now, in terms of the application of the arm's length principle, the transfer pricing guide in the UAE has devoted a whole chapter around this application of the arm's length principle. It provides here, we're just going to give a bit of the summary, but the good news is that actually there is guidance on this. We know how we should be applying the arm's length principle to assess the arm's length nature of the related party transaction. So to start with, the first thing is that someone needs to do is basically to, as we say, to define the scope. What is in the scope of transfer pricing? So what are the related parties? The first thing is someone needs to start with the identification of the related parties. The second step is basically to identify the relevant transactions. Basically, let's say you have one company in UAE, another company in Spain, and the transaction is provision of services from Spain to the UAE. Both of the companies, they belong in the same group, so by the transfer pricing legislation and the corporate tax rules, they are considered related. The transaction as well is a relevant transaction. And then the other thing that is falling within the scope is the comparability analysis. The comparability analysis actually means to basically check the transaction, the controlled transaction you have in place, in our example, the management services with uncontrolled transactions. So it basically is the comparison of the results that you are having from the controlled transaction with uncontrolled transactions. Once you have completed this step, and actually that we have also to mention here that the tax authorities, FTA, is putting a lot of emphasis on the functional analysis, spending a number of pages, and that shows the importance they will be showing on the function analysis. With function analysis basically means the functions performed, assets used, and risk assumed by the both parties of the transaction. The functional analysis is very critical because with the functional analysis, you can determine what is the most appropriate transfer pricing method to use. As Shiraz mentioned previously, in terms of TP methods, it's the methods, the OECD approved methods, the comparable and controlled price method, the resale price method, cost plus, transactional net margin method, and the profit split method. Also, they recognize in case that none of these methods can be applied, alternatively, other methods should be applied. Pretty much the guidance and the language on the application of the methods is similar to what we have seen before on OECD, and is also direct reference to the OECD as well. And once someone has selected for that transaction the most appropriate TP method. So in our example, services from Spain to the UAE, most likely a common TP method to use in that case can be the transactional net margin method to test the absolute nature of this transaction. The next step is the determination of the price. So this is very transactional specific. It depends on the type of transaction and the type of the TP method that has been selected. But in a nutshell, these are the three steps that can lead to an arm's length price. We should also keep in mind that in the world of transfer pricing, there is not exact, because the nature of transfer pricing is subjective. There is not an exact price, it's only a range of results. So it's very common, you will see when someone a tax advisor is providing, is doing an analysis on this, to give a range of results, because this is what commonly we see in the market, and this is what is communicated as well. You will almost never see that will be provided only one select price. The thing is that we will give a range of results, and then the tested party in each case should ensure that is within this range of results. Next slide, please. So now in terms of transfer pricing documentation requirements in the UAE, as you can see from this slide, is quite burdensome, but is mostly in line with what we see in other jurisdictions in the region. So to start with, there are 3 documents that are also OECD compliant. These were basically coming from the BEPS project. So having said this, this one is the local file, second is the master file, and the third one is the country-by-country reporting. These are standardized templates are coming from the OECD, and their UAE doesn't mention any specific differences from the OECD templates. Most likely, they will follow exactly the same content. What is specific in the UAE, but we have seen that in other jurisdictions as well in the region, is the transfer pricing disclosure form. The transfer pricing disclosure form is basically a form that goes together with the tax return, where you specify the related parties, the value of the transactions, the transfer pricing method that has been used, and this should be filed together with the tax return within 9 months from the end of the financial year. Local file and master file, they have a materiality threshold. This is firstly if you are part of a multinational group. So if you are a pillar 2 company, actually, meaning consolidated revenues of 3.15 billion, you need to prepare a local file and a master file. And this is submission upon request and is within 30 days. In terms of the content now of the local file basically gives some more information on the local entity. So in this case, can give some more information on the UAE entity, the related party transaction that is this entity is involved, and as well its overall contribution to the value chain. The master file is typically a document prepared at a group level. It gives a big picture. It explains actually where this group has operations, the key related party transactions within the group, as well key intangibles, etc. We have to mention that there is an exception here that if a UAE group is a pillar 2 group, has 3.15 billion of consolidated revenues, but has only operations in the UAE and not outside the UAE, that group doesn't need to prepare a master file. Country-by-country reporting is already in the law since 2019. It's only limited now to UAE headquarter groups. It's basically groups that are pillar 2 groups. They are headquartered in the UAE, so it's not a requirement for any non-UAE groups. They need to file the CBCR report, a report with financial information, mostly, and some qualitative as well information within 12 months from the end of the fiscal year, and that refers to, and also they need to file the CBCR notification no later than the last day of the fiscal year to which the CBCR relates to. Now, we're not going into details, but it's, I think, quite important to mention a few things that are specific to the transfer pricing regime in the UAE. Firstly, there is a need to prepare contemporaneous TP documentation. Having said this, contemporaneous TP documentation means that basically you have to prepare the TP documentation either at the time that the control transaction is taking place or by the time you file the tax return. That's actually an interesting point in the FTA guide. The other is on the transactions, as we said, domestic transactions with free zone companies are falling within the scope of transfer pricing. We should mention as well that there is a requirement to prepare benchmarking analysis or comparability studies with the use of domestic comparables. We know that it's actually difficult to have this data because they're not available actually. So, but tax authorities, they request that you have searched for domestic comparables. If you are not able to find domestic comparables, you look for regional comparables and then for global data. So if a group it's a European group and they have, let's say, a policy around intra-group loans or services, and they're using data that are European data, they need to rethink about using that benchmark study in the UAE, because tax authorities in the UAE, they need to see that you have actually performed a search using, or at least looking for local comparables. As we previously mentioned, transfer pricing rules in the UAE, they follow the OECD guidance. We also have to say here that a company that they have elected for the small business relief, they may not have to comply with the TP documentation. However, they are required to comply with the arm's length principle. So a key message to all companies is that irrespective of the size of the business, you need to comply with the arm's length principle. And you need to be able to demonstrate to the tax authorities at any point that the proof of it, how do you comply with the arm's length principle. Don't forget that in Article 55, paragraph 4, it is mentioned that TP documentation, or tax authorities, they have at any point the right to request information that proves that you have priced your transactions in line with the arm's length principle. So if you don't meet the thresholds in terms of TP documentation, it doesn't necessarily mean that you should not keep any supporting documentation. And supporting documentation, it doesn't need to be in the form of a local file, but it can be in the form of benchmark analysis, intra-group agreements, invoicing, etc. And the other point is on the reliance on transfer pricing policies. So in that case, the TP guide allows taxpayers actually to use transfer pricing policies that are prepared at the global level. However, they need to ensure that this transfer pricing policy is actually localized. You use local comparables if needed, and they need to see if it's truly in line with the local requirements. So next slide, please.
So moving on to qualifying free zone persons and their interaction with transfer pricing. As Shiraz mentioned right at the start of the presentation, in the UAE, taxable income up to 375,000 dirhams is taxable at a rate of 0%, and any taxable income in excess of that is subject to 9% corporate tax. Unless you're a Pillar 2 M&E, in which case it is expected that a higher tax rate will apply to you in future. However, qualifying free zone persons, which means persons that are registered, entities that are registered or incorporated in free zones that satisfy certain conditions, are subject to a preferential tax rate of 0%. Now, in order to qualify as a qualifying free zone person, you're required firstly to maintain adequate substance, which means maintaining adequate assets, employees, adequate expenditure capital in the free zone, and that your core income generating activities are performed in the free zone. And this is essentially to prevent entities with no substance from incorporating in a zone where there is a preferential tax rate when they don't actually have operations there. And secondly, the companies need to make an election not to be subject to corporate tax. The companies also need to prepare financial statements that are in accordance with the international financial reporting standards, and these financial statements must be audited in order to qualify. And they need to also derive qualifying income, and this is one of the most critical conditions, in the sense that it is not automatic or just a tick box exercise. In order to generate qualifying income, there are different rules depending on whether you are transacting with free zone persons, with other free zone persons, or whether you're transacting with persons outside of free zones. If you are transacting with persons in free zones, your income is qualifying if it is generated from activities, from any activity other than an activity defined as an excluded activity. And the relevant regulations contain a list of excluded activities. On the other hand, if your income is generated from transactions, to the extent that your income is generated from transactions with non-free zone persons, your income is qualifying to the extent that it is generated from an activity that is listed as a qualifying activity. So it needs to be specifically from those activities, and it also needs to not be an excluded activity. And again, there is a list of qualifying and excluded activities. Any income that does not fall within these categories is called non-qualifying revenues. And if the non-qualifying revenues exceed the lower of 5 million dirhams or 5% of the company's total revenues, then the entity is not a qualifying free zone person and is subject to 9% corporate tax on all of its taxable income in excess of 375,000 dirhams. On the other hand, if the non-qualifying revenues are below the threshold, then the company is generally subject to 0% corporate tax on all of its income, as long as it satisfies all of the other requirements. And so for each entity, it is essential that they carry out an analysis of where their income is being generated from and whether it's qualifying or not. And lastly, in order to qualify as in order to be designated as a qualifying free zone person, you need to comply with the arm's length principle and with the transfer pricing documentation that Yanis was just discussing now. And this means that even though a qualifying free zone person is subject to 0% tax and is essentially not paying tax, if they don't qualify with the arm's length principle or they don't prepare the required transfer pricing documentation, they will be disqualified from being a qualifying free zone person and they'll be subject to 9% corporate tax on their income. And so the price of not complying is quite high, especially in the case of qualifying free zone persons. And I think it's also important to note that if you are disqualified from being a qualifying free zone person, you're disqualified for these 4 subsequent tax periods. So that means that if you're not qualifying this year, you're also not qualifying for the next 4 years. And so it is critical that the arm's length principle and transfer pricing documentation is complied with to avoid such a long period of disqualification from the preferential regime in free zones. So just to give an example of how it works when you're interacting with free zones, if you take an example of a UAE distributor that is providing goods that are qualifying, for example, manufacturing of goods, processing of goods, trading of certain qualified commodities can be qualifying with reference to the list of qualifying excluded activities. But assuming that the income generated is qualifying income from that activity and it's subject to 0% corporate tax, you would need to look at the functional profile of the entities. You would need to conduct local benchmarking analyses. You would need to maintain TP documentation to the extent that you're required to do so. Look at the intergroup agreements and the invoicing, and all of that goes together in determining the arm's length price of the related party transaction, ensuring that the transaction is carried out at an arm's length price in order for your qualifying free zone person status to be maintained.
Thank you, Sheikh. So on this now, the transfer pricing guide has a very big part, a big chapter that deals with specific transactions, special for specific cases. To start with, the one common transaction we see in the region is financial transactions. So this is mostly focusing around intra-group loans. We've seen quite a few times the parent companies giving interest-free loans to subsidiaries, or subsidiaries, among them, they give loans to each other. These interest-free loans, or not priced correctly with supporting transfer pricing analysis, loan arrangements will not fly from now on. So taxpayers need to keep in mind that when you have to do and they have to price the intragroup loans in line with the arm's length principle. What that basically means is that firstly you have to assess the terms and conditions of the loan arrangement, things like the maturity, the currency, or etc. Other things as well, other factors that can play a big role in this. The other thing is someone needs to determine the borrower of the credit rating. We know in many cases when a company is not a listed company, it's actually difficult to get the credit rating of the borrower, but there are transfer pricing tools that someone can use to assess and assume a credit rating. And based on this one, someone can do a benchmark analysis, look for data, comparable loan arrangements or bond issuances to see and price accordingly the intragroup loans. Apart from this, we also see a treasury function that is falling within the scope of the financial services. Hedging, in many cases, multinational groups are using hedging instruments to reduce the risk within the group. Cash pooling activities is basically to ensure that there is a proper financial management and funds available to all the group entities. Cash pooling can have typically there are two types, notional cash pooling or physical cash pooling. Captive insurance, in many cases, one entity of the group is insuring the risk of certain risks within the group, and also the financial guarantee. Actually, it's another area, how to price a financial guarantee, what someone needs to pay for having a financial guarantee to its related parties. This is mostly with financial transactions. Now we can move on to the most common transaction, related party transaction we have seen so far in the UAE. This has to do with intragroup services. We have a lot of clients, they come to us and they are asking how to charge out intragroup services, what is the appropriate cost base to use, reimbursement of expenses, how to treat this, shareholder costs, etc. What is the appropriate treatment of this? So in terms of intragroup services, there are two key questions. The first one is whether these services have been rendered, have been provided or not. And the answer to this is coming from what we call the benefit test. Someone needs to conduct a benefit test and see if the recipient of the services has actually received the benefit or not. Within that type of question, there are a lot of things that someone needs to consider, as well as the application of services, incidental benefits, as well as shareholder costs, what is the treatment of all of these different elements. And once someone has determined that the benefit has been received, then the next question is coming on the determination of an arm's length range for the intragroup services. How do you charge out this cost? The starting point of this is you need to identify what is the appropriate cost base, what are the costs that should be allocated. Then the next thing is which costs are direct costs and which costs are indirect costs. There also can be some pass-through costs. Each type of cost has a different treatment from a transfer pricing perspective. It doesn't mean that you have all of these costs and you can simply charge out this cost, or you put in all of these costs a profit margin. Each type of pool of costs has a different transfer pricing approach that needs to be followed. And this is something we are expecting will have great scrutiny from the tax authorities, because this is what we commonly see. And in many cases as well, these services are free of charge. The group is providing management services, but the subsidiaries are not paying for this. Again, this will not fly that easily from now on. And the next area that's actually quite critical and important is around intangibles. So intangibles can be patent, know-how, trademark, etc. We have also to mention that not all of type of IP is considered IP for transfer pricing purposes. As an example, synergies is not an IP from a transfer pricing perspective. So the transfer pricing guide puts in place a 6-step approach that someone needs to follow in order to determine an arm's length price for intangibles. The first step on this is basically to identify the intangible used or transferred. The second thing is to find out what are the contractual arrangements around this transfer of or use of intellectual property. The third step is the DEMPE analysis. DEMPE stands for Development, Enhancement, Maintenance, Protection, and Exploitation. Is basically a framework that was designed by the OECD to allocate the economic ownership of the IP to the relevant parties. So it is basically on the allocation of the economic returns of the IP. The fourth step is the actual conduct of the parties, because many times we see there is a difference on what actually the parties are doing compared to what is the contractual arrangement. Fifth step is the delineation of the transaction, and the last one is to determine the arm's length nature of the transaction.
So moving on to permanent establishments, as we've discussed previously, transfer pricing generally applies to transactions between related parties, related entities, related persons, the purpose being to prevent profit shifting, profit manipulation from, for example, high tax to low tax jurisdictions, or profit-making companies that pay a loss of tax to loss-making companies that do not pay tax. But where a permanent establishment of a foreign company exists that is part of the same legal entity, that permanent establishment would also be taxable in the UAE, and so TP rules also apply to transactions between permanent establishments and their head office and all other transactions involving permanent establishments where they're with related parties. And so what is a permanent establishment? A permanent establishment is essentially a fixed place or permanent place of business in the UAE through which the business of the non-resident person is conducted. You can also have a permanent establishment in what is commonly referred to as a dependent agency scenario, which is where a person has and habitually exercises an authority to conduct a business in the UAE on behalf of a non-resident person. That also gives rise to a permanent establishment. And so where there is a permanent establishment, TP rules apply to permanent establishments and their transactions with related parties, and these transactions would need to be conducted in line with the arm's length principle, which Yanis has just been discussing. And the way it works is that the arm's length principle requires that a permanent establishment to be treated as a separate entity for transfer pricing purposes from its head office and from the rest of the group, notwithstanding that from a legal perspective, it may be seen as the same entity. From a transfer pricing perspective, it is a separate entity, and that is the basis on which the arm's length principle applies to transactions between permanent establishments and their head office. And so to accurately attribute the profit between a permanent establishment and its parent, you need to carry out two steps. The first step, you need to conduct a functional analysis, identify the activities that are performed by the permanent establishment and the head office. And then the second step, you need to determine the compensation of the transactions between the head office and the permanent establishment. And so when carrying out this exercise, the first step that you would need to do is consider whether there is a permanent establishment in the first place. For example, if a foreign company was to send employees to the UAE and those employees were to spend a significant amount of time and their activities exceed beyond the threshold, and that creates a permanent establishment, then the profits attributable to the permanent establishment that arises as a result of the employee's presence in the UAE would need to be taxable, and because the services might be provided to the head office, that would need to be done at an arm's length basis. There are also certain circumstances where a fixed or permanent place in the UAE would not give rise to a permanent establishment, because there are certain exceptions to this rule, where, for example, the activities carried out are of what is considered a preparatory or an auxiliary nature, meaning that the level of activities is so low, it does not really constitute a business activity. It's merely preparatory. The OECD provides a lot of guidance over what that constitutes. And so if that is the case, and most commonly we see that in the activities of representative offices in the UAE. Not all rep offices are accepted from being a permanent establishment. There's no single type of entity or license that falls within the exception. It's on a case-by-case basis and with reference to the substance and activities of each office. But if it is accepted from being a permanent establishment and there is no permanent establishment, then transfer pricing would not apply. And so the first step would be to determine where there is a presence, if that presence constitutes a permanent establishment, and if so, then you would need to conduct a TP analysis to ensure that related party transactions are carried out at an arm's length basis. And so just to tie that back into how this would look in your tax return, in determining the corporate tax that's payable, ultimately the corporate tax that's payable is based on your net accounting profit or loss. And there are certain adjustments that need to be made in line with the provisions of the corporate tax legislation. For example, taking into account income that is exempt from tax, permissible deductions, tax loss relief, or any other type of relief or adjustments that are prescribed under the corporate tax law or related decisions. And the key there is that any adjustments can and must be made where there are transactions with related parties if those transactions were not at an arm's length basis, to ensure that for tax purposes, the profit that is reported is at an arm's length basis in determining your final taxable income. And so based on your final amount of taxable income, you would then apply the corporate tax rate after deducting any tax credits, such as withholding tax credit or foreign tax credit, if any is applicable in that scenario. And so moving on to transfer pricing audits and risk assessments, the burden of proof in demonstrating that the arm's length principle is complied with initially falls on the taxpayer. The taxable person is required to maintain supporting documentation and to make timely submissions to the FTA in line with the requirements that are applicable to it based on the materiality thresholds that Yanis had discussed earlier. And the FTA does have the right to question and make requests for information and review the data, and it's on the taxable person to respond to and to justify any questions that are raised by the federal tax authority. Although if the FTA does want to issue an assessment later on, it is also required to substantiate the assessment. But in the first place, the burden of proof is on the taxpayer to respond to questions, to respond to requests for information, and to clarify anything that is requested by the tax authority. In terms of transfer pricing adjustments can be made both by the taxpayer and the FTA. I've just mentioned in the previous slide that in the tax return, you can make adjustments based for related party transactions to take into account the arm's length price that should be reported for tax purposes. The FTA can also, following an audit and a review, issue an assessment and adjust the taxable profits if it feels that related party transactions were not conducted in line with the arm's length principle. Taxpayers do have the right to request clarifications from the FTA on matters that are vague or unclear, or if a taxpayer has obtained professional advice and there remains some vagueness in terms of the tax treatment of the transaction or the applicable arm's length price. A request for clarification can be submitted through official channels to the FTA, requesting clarification on the specific point being raised. And taxpayers are able to make real-time adjustments before submitting their tax returns or afterwards, although it is always preferred that it is done at the time of the tax return and not afterwards, because penalties could apply. And finally, the FTA does have the right to carry out adjustments or even not recognize transactions if there is no commercial rationale for the transaction and if the transaction's principal purpose is to obtain corporate tax advantage. In these types of transactions, the FTA can adjust the price, or it can disregard the transaction and pretend that it never happened, and this is commonly referred to as the general anti-avoidance rule.
Thank you, Yusuf. So now in terms of the key takeaways, we are now discussed with a number of clients on the transfer pricing implications of their related party transactions. So the first thing is that someone needs to conduct a holistic review of the current intercompany arrangements. They need to look into if they receive any services, loans, IP, etc. Even if there are some transactions that are free of cost, someone needs to start considering, do I get a benefit? If I receive a benefit, then normally I will have been paying a third party for this. So need to start thinking outside the box and outside of the practices of the past, because now tax authorities, they have put in place a very robust transfer pricing regime. There is a guide with 140 pages. There is a number of ministerial decisions. We just mentioned here one of the most important OTP documentation, but there are a few things that, let's say, tax groups, free zones, there are interactions with transfer pricing with all of these other tax areas. So someone needs to see from a holistic perspective, and as well from a group perspective, the impact of transfer pricing in the UAE. What is the law saying is basically that transfer pricing rules and the arm's length principle is applicable to all businesses, even if it's a small business, if for a free zone it's a necessity as well. So we'll strongly recommend in any of these cases that someone is preparing the transfer pricing documentation as recommended and as described in the law. But even in the cases that let's say we have a free zone company that is below the threshold, has revenues of 50,000 dirhams per year, but the income comes from related parties. This transaction is a high-risk transaction. It's also at a high risk, the position of the company as a qualified free zone person, because as I mentioned before, if one of these criteria is not met, then they can be disqualified for a number of years as a free zone person. So it's critical in the analysis, and it's very important to ensure that you comply with the arm's length principle. That's first. And the second point is ensuring that you have the right documentation in place to support this. And with what documentation, as we mentioned before, is not only local file or a master file, can be also used invoices, agreements, transfer pricing policy in place. Maybe someone that is below the threshold can think, okay, why not doing a benchmark analysis just to have a support, and I can give this to the tax authority. So it should be more thought given around this. And also in the future, because also what we have seen from the FTA in terms of VAT assessments, we are expecting similar to ZAC and Saudi and other tax jurisdictions in the region, that they will be quite aggressive with transfer pricing matters as well. So next slides, please. In terms of, as we said, this is actually how we can assist you from the beginning, from analyzing and making a transfer pricing assessment, designing your transfer pricing policy, compliance, and also with litigation support. And I think with this, for the sake of time, we can take some few questions. I see here there is one question, maybe say you can take this question, is around the local file and the master file. The question is around whether taxpayers have to prepare this on once and they're good every 2-3 years, every year, or what is the guidance around this?
So it needs to be done annually, and taxpayers need to be prepared to submit it to the FTA within 30 days of being requested to.
Okay. So pretty much it is aligned with what is as well in the OECD. I guess this question should be for me, is in terms of the comparables and how frequently the benchmark study should be conducted. So as is the case for OECD, there is one benchmark study that should be conducted every 3 years. In the meantime, when someone has done the benchmarking study, the other 2 years, it can be basically an update of the financials of the comparables. There is no need to conduct a fresh benchmarking study every year, every 3 years, on the assumption that there is no significant change on the type of transaction. the same benchmarking study can be used. I think there is one question I just see here, it's quite interesting about transfer pricing adjustments, corresponding adjustments. What is your view on this, Saif?
Yeah, so under the corporate tax law, where there is an adjustment that is made by a foreign tax authority to the arm's length price in a cross-border transaction, UAE taxpayer can make an application to the FTA to request that they apply that adjustment in the UAE as well.
Mm-hmm. Oh, okay. So similarly, like to other jurisdictions as well, they have.
To ensure the consistent prices being applied. You're not applying one price in one tax return and another price in a corresponding tax return in another jurisdiction for the recipient and the supplier or vice versa.
Interesting. I see a number of questions that are coming. Unfortunately, we will not be able to cover all of these questions. There is one, it's actually quite interesting around the comparables, and that is, I mean, we mentioned that before, but I think we have to make it clear that taxpayers, when they use a benchmark study and they try to defend the pricing of a specific controlled transaction, they need always to show to the tax authorities they looked for domestic comparables. Even if they are not domestic comparables, in the search strategy, someone needs to include UAE as a region and as a country that someone has looked for comparables. Then to expand this search to regional data, and this is typically what we do in most of the cases in terms of benchmark studies. So we look for Middle Eastern comparable companies. And then if it's not possible, let's say in the case of long searches, we can use global data. And I think with this, we can conclude the session.
I think we can try to answer the other Q&As by email. We haven't had time to go through them all, so we'll do our best to respond to all questions by email.
And we will be sharing as well the presentation over an email. Thank you all for your attendance.